Right now, as you watch this, there is a 10 a.m. deadline ticking, and if you don't understand what that deadline means for your silver position, you are going to watch money walk right out of your portfolio and into someone else's hands. Here's what's happening. Silver just moved, hard, and 90% of retail investors have no idea why. They see the price spike, they panic buy the top, or they freeze and do nothing. Both are wrong. The real reason silver is reacting right now has nothing to do with inflation. It has nothing to do with the dollar. It has everything to do with a room full of diplomats, a ticking clock, and a nation that controls one of the most critical choke points in global energy markets. And then, just when you think the silver story can't get more interesting, there's a gold discovery sitting underneath what everyone thought was just a silver mine. Keno Hill, a name that most retail investors haven't heard yet. But institutional money? They're already moving. I'm going to break all of this down, chapter by chapter, so by the end of this video, you'll have a complete picture. The macro, the geopolitics, the technicals, and exactly what to do with this information. Stay locked in. This matters. Let's set the scene. Silver has been the sleeping giant of the commodities market for 2 years. Gold has been on an absolute tear, breaking all-time highs, gaining institutional respect, central banks hoarding it like never before in modern history. Silver? Silver has been the quiet cousin sitting in the corner, but here's what changes everything. Silver is not just a precious metal, it is an industrial metal. It goes into every solar panel, every EV battery management system, every semiconductor connection, every defense system radar array. Silver is where geopolitics meets green energy meets technology. And when you understand that, you understand why an 8 p.m. diplomatic deadline in the Middle East can send silver moving in minutes. The global silver market is running a deficit. That's not a talking point, that's a hard data fact. The Silver Institute reported a structural supply deficit for the third consecutive year. Above-ground inventories on the COMEX are shrinking. Registered silver stocks, the metal that's actually available for immediate delivery, have dropped to levels that make traders nervous. Now layer on top of that, a geopolitical flashpoint, and you have the conditions for a violent, fast move. This isn't speculation, this is cause and effect, and the effect is already happening. But here is the part nobody is telling you. While retail investors are Googling, why is silver going up? The institutional players already repositioned weeks ago. How do we know this? The Commitment of Traders report, the COT data. This is the weekly X-ray of the futures market. It shows you exactly how the big commercial traders, the banks, the hedge funds, the producers, are positioned. And in the last 3 COT reports, something shifted. The managed money category, that's the hedge funds, massively reduced their short exposure in silver. At the same time, the commercial category, that's the big banks and industrial buyers, reduced their net short hedges. Translation, the people who are closest to the physical silver market are less bearish than they've been in 18 months. That's not a casual change, that is a signal. Goldman Sachs published an internal commodities note, picked up and referenced in Bloomberg, flagging silver as uniquely positioned at the intersection of the energy transition demand story and classic safe haven buying. JP Morgan's commodities desk has been quietly accumulating silver exposure in structured products since Q1. These institutions don't announce their moves, they act, then retail finds out later. You're finding out now, and here's where Keno Hill enters the picture. Because institutional money is also quietly accumulating in a specific equity that gives you leveraged exposure to both silver and a gold discovery that the market hasn't priced in yet. We'll get to exactly what that means in Chapter 5. Wait, it gets even more interesting. The 8 p.m. deadline. Let's talk about what that actually is. Nuclear negotiations between the United States and Iran have been moving in fits and starts. But recently, a specific session, with a hard diplomatic cutoff time, became the flashpoint. Here's why silver reacted specifically to this. Iran controls the Strait of Hormuz. Roughly 20% of all globally traded oil passes through that strait every single day. When Iran is in the news for any adversarial reason, sanctions escalation, nuclear posturing, proxy conflict escalation, the energy markets move, oil moves, and when oil moves, it creates an inflation expectation signal. And when inflation expectations rise, hard assets, gold, silver, oil itself, get bought as a hedge. But here's the layered trade that most people miss. Silver has a dual role. It's a safe haven asset like gold, and it's an industrial commodity. So when geopolitical stress hits, silver gets bought on the safe haven bid. And separately, the energy transition, solar, EVs, grid storage, is still structurally demanding more silver every single year, regardless of what happens in diplomacy. So silver is being pulled from 2 directions simultaneously. The geopolitical catalyst closes one buy signal. The green energy structural demand never closes. That's why this moment is different from the silver spikes of 2011 or 2020. Those were single driver moves. What's happening now is a multi-driver convergence. multi-driver convergences are harder to reverse, and the technological driver is accelerating. The International Energy Agency updated its silver demand forecasts upward. Solar photovoltaic manufacturing alone is projected to consume 200+ million ounces annually by 2030. The entire global silver mine supply is approximately 820 million ounces per year. Solar alone will eat nearly 25% of that. Add electronics, add EVs, add defense. The math gets uncomfortable very fast. Now let's get into the numbers, because this is where it gets real. Silver's gold-to-silver ratio, the GSR, is one of the most reliable historical valuation tools in the metals market. Right now, as of this recording, the GSR is sitting near 88.1. That means it takes 88 ounces of silver to buy 1 ounce of gold. The historical average over 50 years is approximately 65.1. In the explosive bull markets of 1980 and 2011, the ratio compressed to 35.1 and 32.1 respectively. If we see even a mean reversion to 65.1, not an extreme, just average, and gold stays where it is, silver needs to move dramatically higher to close that gap. That's the mathematical argument for silver's upside. Now, Keno Hill. Hecla Mining acquired the Keno Hill operation in Yukon, Canada. The original thesis was simple. It's one of the highest grade silver deposits in the world. Keno Hill silver grades average above 800 grams per ton. That's extraordinary. Most primary silver mines operate at 100 to 200 grams per ton. Keno Hill is in a completely different class, but here's what the market didn't price in. The geological surveys and drill results coming out of the deeper zones at Keno Hill are returning gold assays that are frankly surprising. Not trace gold. Significant gold mineralization in structures adjacent to and underneath the primary silver-bearing veins. This is what geologists call a polymetallic system. The silver is the headline, but the gold potential at depth is the story nobody's writing about yet. Analysts covering Hecla have revised their resource models. The net asset value calculations, the core of junior miner valuation, look materially different when you add even a modest gold endowment to a high-grade silver resource. But here is the part nobody is telling you. The market is still valuing Keno Hill almost entirely as a silver asset. The gold optionality, the blue sky upside from the gold discovery, is essentially free right now in the share price. That's a mispricing. Markets eventually correct mispricings. The question is always, are you positioned before or after the correction? Okay, here's what you actually do with all of this. Step 1. Understand your entry framework. Don't chase a spike. Silver moved fast. If you're watching this in the immediate aftermath of the Iran headline, the first reactive spike may already be in. Wait for the pullback to a defined support level. The 2850 to 2950 range has been a key technical support zone. Set your alert. Be patient. Reactive buying at the top of a news spike is how retail loses money. Step 2. Size the physical versus paper position correctly. Physical silver, coins, bars, is your insurance. It does not go bankrupt. It cannot be diluted. Start with a 5% to 10% physical allocation of your total investable portfolio if you don't have it already. Dollar cost average in. Monthly purchases remove the timing pressure. Paper silver, ETFs like SLV or PSLV, give you liquidity and price exposure without storage logistics. PSLV specifically holds allocated, audited physical silver. It's cleaner than SLV from a counterparty risk standpoint. Step 3. Add the equity kicker for leverage. If your risk tolerance allows it, a small position in primary silver miners gives you leveraged exposure to silver prices. When silver moves 10%, well-run silver miners can move 20% to 30% because of their operating leverage. Hecla Mining, the Keno Hill parent, is worth researching. First Majestic Silver is another name with high operational leverage to spot prices. Do your own due diligence. These carry significantly more risk than physical or ETFs. Step 4. Set a thesis checkpoint. The Iran nuclear negotiations have a timeline. The green energy structural demand does not. Check your position quarterly against these two drivers. If the geopolitical risk resolves favorably and the safe haven bid fades, the industrial demand story still holds. But if both drivers reverse simultaneously, that's your signal to reassess. Step 5. Watch the COT data every Friday. The CFTC releases it weekly. It's free. It tells you in real time what the big money is doing. When commercial shorts start rebuilding aggressively, that's a warning. When managed money-long positions get overly crowded, that's a warning. Use it as a positioning gauge, not a daily trading signal. This is how sophisticated investors think. Not silver good, buy silver, but structured, thesis-driven, data-checked positioning with defined entry zones and exit conditions. Picture this. 12 months from now, you sized into silver at the right level. You held through the noise, the fake breakouts, the dips that felt scary, the headlines that confused everyone else. You watched the gold to silver ratio compress from 88 back towards 65 as silver caught up to gold's move. You watched Keno Hill's gold discovery get properly priced in by the market as more drill results came out. Your physical stack is sitting there, quietly, doing exactly what insurance is supposed to do. You didn't panic, you didn't overtrade, you just understood the thesis before the crowd did, and you held the line. That's what this information is worth when you act on it correctly. But here's the next problem you're going to face. And I'm going to make a video specifically about this. Once silver moves, once the GSR compresses and your position is up significantly, when do you take profit? Do you rotate into gold? Do you move into gold miners? Do you take cash off the table and wait for the next cycle? The exit strategy for a precious metals bull run is just as important as the entry, maybe more important. That's the video coming next. Make sure you're subscribed, hit the notification bell, because when that video drops, it will be time sensitive, just like this one was. The clock is always ticking. The question is, whose side is it ticking for? See you in the next one.